Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. This year started with a bang. Following the abandonment of the zero-COVID policy in the final days of 2022, the Omicron tsunami led to over 1 billion infections and more deaths in 2 months than the US saw in more than 3 years. One China commentator said that the surge in COVID deaths represented, quote, the most lethal event in peacetime China since the Great Famine that followed the Great Leap Forward, end quote. The big moves didn't stop there. In March, Xi Jinping secured a third term as China's top leader and appointed protégés to key positions in the State Council, including Li Qiang, who would become premier, as well as ministers Qin Gang and Li Shangfu, who would both disappear and be removed from their posts in later months. In the foreign policy space, China was busy too. Its influence remains strong in lower and middle income countries outside of Asia, and the Third Belt and Road Forum was attended by 20 heads of state and government from around the Third World. However, in the developed world of the West and East Asia, China's reputation has plummeted. Negative perceptions of China in the United States reached new highs, with 83% of adults holding unfavorable views of the country. US-China competition has intensified, as has EU and Japanese China skepticism. In October, the Biden administration escalated its semiconductor and technology war with new restrictions on advanced computer chips. In June, China brokered a peace deal between Saudi Arabia and Iran. It continues to support Russia and Ukraine and has sided with Palestine and Iran in the Middle East. Tensions with the US and her allies in the East and South China Seas are at their worst levels in decades too. And then there is the economy. It's the last episode of China Update for the year, so for today I thought it would be useful to have a year in review for the Chinese economy. The PRC was expected to recover quickly in 2023 and resume its role as the so-called engine of global growth. After all, after a surge of cases immediately after the abandonment of zero-COVID, it was said that China would see a year of consumption-led growth and households engaged in revenge spending. With this consumption-led growth, policymakers would have had the space needed to push through the reforms necessary to tackle systemic economic issues, most notably the housing crisis and local fiscal pressures. Of course, this did not happen. Economists have been revising their forecasts for China's growth almost all year long in 2023, as the economy experienced a burst of speed early on, only to see momentum dwindle over the course of the year. Consumption has remained stubbornly weak, debt has continued to surge, youth unemployment is at record highs, and both the housing and fiscal crises are set to enter yet another year. This year also saw a collapse in foreign direct investment, over 90% down by some measures, as we explored yesterday. Exports have been a mixed bag too. But exports to Russia, they have surged. Chinese exports of transportation equipment to Russia especially, that's everything from railway cars to ships, have risen 800% since Russia invaded Ukraine. During the annual legislative meeting in March, China's top leadership set the growth target for the whole year at around 5%, lower than many economists' forecasts for actual growth at that time, which were as high as 5.8%. Beijing has achieved its goal of approximately 5% growth, but as always, we must look past these headline numbers. Quote, despite clear evidence that it was slowed down by unexpected economic headwinds this year, China will almost certainly claim to have hit its around 5% GDP growth target for 2023. The realities of a still shrinking property sector, limited consumer spending, falling trade surplus, and battered local government finances mean that actual growth in 2023 was more like 1.5%. Looking ahead, China may see a cyclical recovery to perhaps 3 to 3.5% growth in 2024 as property bottoms out, although structural slowdown will naturally remain the dominant story for years to come. End quote. Other commentators are more pessimistic, and policymakers are indeed facing a tough year ahead. Quote, the 2024 challenge for the Chinese economy will not be GDP growth. That will likely be above 4.5%. The challenge will be that the only direction from there is down." End quote. Without major market reforms, he adds, China could be stuck in what economists call the middle-income trap. China is expected to see the world's biggest millionaire exodus this year, while the number of Chinese nationals apprehended crossing the US-Mexican border into the United States is more than in the previous 10 years combined. What happened this year, then? First quarter economic data met expectations, with a solid recovery in total retail sales and industrial output. It was in the second quarter that things got shaky. China's real estate market, which fell into a slump in 2021 following a government-led deleveraging campaign, remained a major drag on growth throughout the year. Poor retail sales and youth unemployment weighed on market sentiment. Households, still feeling the pain of 3 years of zero COVID, and their household wealth slowly retreating in the face of the housing crisis, tightened their purse strings, with some paying back mortgages ahead of schedule. Businesses, even more shell-shocked from zero COVID, couldn't justify expansion with such weak consumption. This is the place where local governments step in to fill the lacuna with fiscal spending. But with sky-high debt and the double revenue hit of tax breaks to spur business activity and collapsed land use sales, the government was hesitant to open the fiscal floodgates, opting instead to incrementally provide support. The central bank cut policy interest rates and financial institutions' revenue requirement ratio a few times to shore up demand for credit. Measures were also rolled out to encourage consumption and to support the private sector. In October, legislators approved the issuance of 1 trillion yuan, $141 billion of additional sovereign bonds in the fourth quarter to finance infrastructure spending. Since August, the government has rolled out a series of measures to further bolster housing demand. Beijing instructed banks to lower minimum down payment ratios and mortgage rates. China's 4 largest cities loosened rules to allow more people to get cheaper mortgages with smaller down payments. Curbs on home buying were eased or scrapped in many cities. Regulators also asked banks to extend more credit support to eligible developers, many of whom had been struggling to complete housing projects and pay back their debts. Quote, "As these stimulus measures were gradually rolled out, the economy gained momentum in the third quarter. That said, economic data for October and November showed mixed results. The property market remained in a slump, and growth in credit supply remained weak last month." End quote. And we still have the worst to cover. I hope you're enjoying today's episode. If you're getting some value from this episode, I only have one ask. That is to like and subscribe. This is the primary way in which this channel grows. The main way it is shown to new people is if the algorithm is happy. For anyone who wants to help keep the channel financially sustainable, which allows me to continue doing this every day, open and free for all, Patreon and Buy Me a Coffee links are in the description below. My commitment has been a channel open to all that is reliant primarily on subscriber support rather than corporate sponsorship. And with your assistance, I know I can keep it that way. Thank you so much, everybody, for the ongoing support. On the equities side, China's 2023 was a massive disappointment to many. Goldman Sachs was among the chorus of Wall Street banks betting big on post-pandemic China's reopening boom. At the beginning of the year, King-Er Lau, chief China equity strategist and managing director at Goldman Sachs, predicted a 15% rally in the Chinese stock market. Instead, Chinese stocks fell more than 15%, one of the worst performances in the world this year. Reflecting on this painful error, Goldman Sachs' head of global rates and emerging market strategy, in an interview this week, expressed, quote, "The first lesson is that you want to treat emerging markets and emerging markets ex-China differently. Chinese assets have been pretty uncorrelated with a lot of the other emerging market assets for some time. That has been true on the equity side and also on the fixed income side. The second lesson is about resilience of broader emerging markets. Even in the face of an aggressive hiking cycle by the Fed, a strong dollar, and a slowing China. That is a pretty bad combination of circumstances for emerging market assets, and despite that, emerging market assets have performed resiliently." End quote. While we're on the equities front, US outlet Bloomberg writes this week that, quote, investors who bought into the idea 2 years ago that China's consumer and green energy stocks stand to win big from President Xi Jinping's renewed economic agenda would have seen their holdings pummeled in 2023, end quote. Car dealership China Meidong Auto Holdings Limited, sportswear manufacturer Li Ning Co., and energy storage system maker Pylon Technologies Co. have all collapsed by at least 68% in 2023, making them some of the worst performing stocks on the MSCI Asia Pacific Index that has more than 1,500 members. Quote, investors should abandon narrow themes and instead look at the quality of each underlying business and its intrinsic value. This will be the more reliable predictor of future returns. Simply aligning around common prosperity as a theme has proven to have its own pitfalls. End quote. They should also, I would argue, perhaps consider watching China Update too. All of you, however, do watch China Update. Some of you have been watching since I started the channel back in 2019. Many began following this year. And what a year it has been. Not just in China, but around the world. One of the reasons I started the channel is because I believe more people need to be following China with grounded, sober, and accurate information and analysis. I think this will especially be the case in the next few years. We are very much living in interesting times, as the jinxing expression goes. This year, it has been a true pleasure to be able to produce daily videos for you all, and I very much look forward to doing the same next year, as we try to follow and make sense of this incredibly complex and interesting country and region in this complex and dangerous time. As we move into the new year, I hope you will continue to follow me on the channel and that the channel can be introduced to new people. For now, I thank you all once again for all of your support in 2023. It has been humbling and incredible to witness and feel all of this support. Thank you all very much. I wish you all a very happy and healthy 2024. Thank you for watching today's episode. Have a great weekend, and I will see you all again next year.